More time, more data, more confidence. This is the message that units the remarks of Fed Reserve policymakers. A great many of them are scheduled to speak at the end of this week and at the beginning of the next. Comments from financial policymakers accompanied by contradictory economic data from China, Japan, and the US trigger high volatility in the currency market. China's economic data released today showed a protracted softness in domestic consumption. At the same time, the country's industrial production expanded by 6.7%, much stronger than the estimated 5.5% growth. That state stimulus measures for production have proven their efficiency. On the flip side, domestic demand discouraged traders. Retail sales slowed down to 2.3% in April. Reports also showed a further decline in property investment between January and April. This is a direct threat to China's real estate rescue plans. By the way, just today, China's Ministry of Finance held an auction to sell the first batch of its special government bonds. Thus, Beijing embarked on a long-awaited program to revitalize the national economy. The U.S. economy remains on a sound footing. This message was delivered by Atlanta Federal Reserve Bank President Raphael Bostic. In his speech yesterday, previously, he has more than once cooled the market's anticipation of multiple rate cuts in the near future. The policymaker did not again last night. A hawk in his viewpoint, Bostic said that one piece of evidence of lower prices in the United States is not a trend. His colleagues, John Williams from the New York Fed and Loretta Mester from the Cleveland Fed, also expressed their views. They reckon that more evidence of a sustained slowdown in inflation is needed to make a decision to cut interest rates. This common reaction from Fed Reserve policymakers followed the inflation data published yesterday. Despite a downtick from 3.5% to 3.4%, the annual inflation rate exceeds the target 2% of the U.S. Central Bank. That's why the hawkish tone of the regulator caused some rebound in the US dollar. The US dollar's growth was capped by the data on the US industrial production, and the consensus suggested that its annual rate would inch up from 0 to 0.1%. At the same time, the previous data was revised for the better up to 0.1%. But the fact is that instead of maintaining momentum, US industry contracted by 0.4%. Therefore, the US dollar was influenced by two contradictory impulses. The greenback could have developed a more impressive rally if it were not capped by the weak industrial production data from the United States. The US dollar index is trading today in the intraday corridor between 104.50 and 104.80. Besides, the index greenback is on a track for a weekly decline against most major currencies, but it's unchanged against the yen and yuan. But as we have seen more than once, new statistics changed everything literally overnight. The annual inflation rate in the Eurozone was confirmed at 2.4%. In April, like a month earlier, the CPI remained at levels not observed for almost 3 years. That's everything is going according to the plan of the ECB. So the first rate cut could be announced at its meeting on June 6. So the euro has to deal with such prospects. And this was mirrored in the euro-dollar pair, considering that the euro occupies an impressive 57.6% of the basket of the greenback rival currencies. The euro-dollar pair sharply dropped within the intraday range of 1.0844 to 1.0872. Although the inflation data in the Eurozone only confirmed the flash estimates and was already priced in by the market, the sudden weakness of the euro looks impressive. Meanwhile, the currency pair pulled back further down from resistance 1.29, but also entered into consolidation in the area of 1.0840 to 1.0850. Thus, we are watching a trend reversal in the euro-dollar pair until buyers stabilize the price above the pivot level of 1.09. A pullback or consolidation will go ahead in the market. As expected, oil is trading predictably today. The Brent price came close to the upper border of the range at $84 per barrel, considering that the market situation remains fundamentally unchanged, and the most likely development of the market is a gradual reversal of the trajectory and the movement towards $82 per barrel. This level now plays the role of the lower border of the range in which the market has been trapped for almost 2 weeks. At the same time, the possibility of a local and temporary breakout of the upper border of practically excluded. After all, the US dollar, as we said today, is aiming to strengthen. In general, the Brent grade has been consolidating between $82 and $84. The pre-launched sideways trading indicates a slowdown in the downward cycle. At the same time, the range-bound market means accumulating trading forces, which will have a positive effect on the volatility after the price goes beyond these borders. You have watched the market review by InstaForex analyst for Friday, May 17. Subscribe to InstaTraders TV channel and we keep you updated on all market developments. Feel free to ask any questions and leave your comments. See you online next week.